This weekend for me started like many others. I woke up about 7:30 or 8 in the morning. My lovely girlfriend bought me a hot cup of coffee. I flipped through a few pages of the book that I'm currently reading. Right now that is Am I Being Too Subtle by Sam Zell. I then rolled out of bed and stumbled to the kitchen, started cooking some breakfast, and of course I put on the brand new latest episode of the Young Investors podcast from Brandon van der Kolk and Hamish Hodder. And one of the things that Brandon specifically talked about on the podcast this week was a 2001 talk that Warren Buffett did at the Terry College of Business. And that was basically a Q&A session that Warren Buffett did with the students of that business school. He got questions on a range of different topics, and a couple of them related to basically how to stay rational during a stock market crash. So last night I went back and kind of watched all the things that Warren Buffett had to say to put together some highlights for this video. And I think some of these timeless lessons from Buffett are super valuable today at a time where we are now officially in bear market territory, with many of the stock market indices in the US down more than 20%. So if you enjoy this video where we go through some of the highlights from that talk from Warren Buffett, where he covers booms and busts in the US stock market, as well as some of his advice on how to stay rational and take advantage of these lower prices, then be sure to hit like and also subscribe to the channel if you are new here. But without further ado, let's get straight into the video. Now, one of the first questions that Buffett got on market cycles and bull markets and bear markets and stock market crashes caused him to talk a little bit about the general history of what happened in the US stock market during the 20th century, where he was first getting started in his investment career. Now, during the 20th century, the GDP per capita growth in the United States was 610%. And if you were to break that GDP growth down by decade, that GDP actually grew every single decade, including the 1930s and the Great Depression. And that basically means that the United States was steadily trucking along, getting more productive, and American business was presumably getting more profitable, and quality of life was of course improving as a result. And of course there were periods where the economy grew faster and when it grew slower, and there were a number of very serious concerning macro events during that century, but by and large the economy was steadily trucking along and growing year after year after year, to the point where it grew, like I say, 610% for the entire century. And if you had been a stock market investor throughout that period, your money would have grown about 180x. $1,000 invested would have turned into about $180,000. And although investors got fantastic results from being in the stock market throughout that century, there were very, very long periods of time where the market went nowhere. And by contrast, there were a small number of years where the market went up very, very fast. Now, for 43 3/4 years of that 100-year century, the US stock market was in a bull market, and for 56 1/4 years, these were periods of stagnation in terms of stock market returns. In fact, the aggregate return from those 56 1/4 years were actually negative, and the 43 3/4 years actually made up for all of that negative return, as well as the entire 180x positive return that you got in stocks during that century. And again, those 56 1/4 years were with a backdrop of a US economy that was growing very, very steadily. Buffett explains this very unusual disconnect between stocks and the US economy basically by saying that investors behave in very human ways. They tend to extrapolate the recent past indefinitely out into the future. In other words, if stocks performed very well last year and your dumb neighbor was getting rich by speculating in certain stocks, you were likely to again invest your money in stocks the next year. And if your experience with stocks had been quite negative and perhaps you lost money last year, it meant that you extrapolated those negative returns out into the future as well, and you were very unlikely to allocate new money towards stock market investments. He said that in 1970, when stock markets had just been doing exceptionally well, pension funds put more than 100% of their new money into stocks, And in 1978, when the stock market was performing very poorly, pension funds put a record low 9% of their new capital into stocks, which is very unusual because when the stock market has been performing well, the stock prices get very high and the future returns look very low, yet people tend to allocate more heavily at periods of time like that versus periods of time when prices are low, forward returns are actually better. People, for whatever reason, tend to allocate very small amounts of capital to stocks at those times. But Buffett did say if you can follow a few very simple ideas and stay rational through these big booms and busts, there is a huge amount of opportunity for you as an investor. So here is some of the advice that Buffett had on how he thinks about investing in stocks to stay rational during these big boom and bust times. The first thing he said is that you need to stay objective and really detach yourself temperamentally from the crowd. He used an old parable from Aesop where he said, "A bird in the hand is worth two in the bush," and he said that Aesop basically had that right when it came to analysing businesses, and there are really only three questions that you need to ask when you are looking to invest in a business. How much cash are you going to get? When are you going to get it? And how sure are you? He explains that if you can't answer that question for a business that you're looking at, then you have absolutely no business investing in that company, even if you've seen your dumb neighbour make money by gambling in stocks or gambling in a particular company in the past. But he did say if you can answer those three questions and it looks like a no-brainer, then he thinks that it makes sense to allocate some capital towards that stock. And he actually went on to say that some of his biggest mistakes in investing are mistakes of omission. There have been investments where he has lost money in the past, sure, but really the biggest mistakes are the ones where he knew enough about the company to make the investment, but he sat there sucking his thumb, as he kind of phrases it. And he then went on to say, when we get the chance to do something right and big, we have to do it. He then went on to speak in a little more detail about intrinsic value and how he tries to understand whether he's actually getting a good price for an investment. And again, he goes back to this Aesop, a bird in the hand is worth two in the bush. And he says basically you need to think about valuing businesses as though they were a bond. Now, of course, when a bond gets issued or when you buy a bond, there is basically information on that bond that tells you exactly what return you're going to get. It tells you what the cash flows are going to be. So maybe when you buy a bond, it says that it's a 2% yield, for example, and it might say that it expires in December 2023, for argument's sake. So that means that you're going to get 2% a year in interest until the end of 2023, at which point you get your principal back. So yes, after you buy a bond, the face value of that bond can swing around wildly if interest rates were to change, but the cash flows that you're going to get after you buy that bond are very easy to calculate. And he thinks that valuing stocks is basically a very similar equation. The trouble is that there aren't cash flows printed on a stock certificate. It's the job of the analyst or the investor to go in and figure out how much cash they are likely to get between now and judgment day, as he calls it, from a business that you might be investing in. Buffett goes on to say that if interest rates are 15%, you need to get two birds out of the bush within 5 years to be equal to a bird in the hand. That's basically a reference saying that you need to be getting a 15% return from your stock market investments to be equal to a bond where you're taking very little risk. If you can get 15% in a bond, and he said if interest rates are only 3%, you can get two birds out in 20 years, and it might still make sense. And of course, all of that is to say that if you can't figure out the cash flows for the business relative to what the price is, you have no business buying the stock. If you were to buy the stock, you would be gambling. It was then really interesting to hear from Buffett on some previous experiences that he had around investor psychology and just how caught up people can get in terms of being super optimistic about stocks or super pessimistic about stocks. He gives the example of a company that he was looking at back in the day, flipping through Moody's manuals, looking at quantitative data for different companies, and he stumbled across a business called the Kansas City Life Insurance Company. Now, the Kansas City Life Insurance Company was a business that was trading at a PE of 3. So if the earnings of that business were steady for 3 years, you would get all of your money back in that short space of time. He said there was no issue with soundness of the company, and he really did think that you could get a 30% return or more by investing in the Kansas City Life Insurance Company. Yet when he went to talk to one of the sales reps for the company who was selling these life insurance products, he discovered that the life insurance policies that people were buying had an implied interest rate assumption, essentially, of about 2% per year. And he said, you know, if I can convince anyone to buy the stock, surely it's this guy selling life insurance for the Kansas City Life Insurance Company. You know, he's already very reliant on the company in terms of getting his paycheck every single week. He sells policies that, you know, he clearly thinks are a good deal if he's selling them with an implied 2% interest rate. And here is the stock of a company that you presumably have a lot of faith in and that you work for, that can give you potentially 30% plus returns per year. Yet his response was just that stocks are no good. He said again that things can go on for a long time that just don't make any sense. You've got to do sensible things to get good results. And he had kind of a funny quote, which was, things that can't go on forever will eventually end, which is something that I guess has stuck with him over time. Sounds extremely obvious, but I think people can get clearly overly greedy and, of course, overly fearful, depending simply on what stock prices are doing. And you have to remain objective and understand what the true intrinsic value of businesses are relative to the price that the market is offering. So those are some of my personal highlights from going back and watching this talk from Warren Buffett in 2001 with the Terry College of Business. And thank you, of course, to Brandon and Hamish for reminding me that this talk even exists, and that there's some, you know, good nuggets of wisdom in there around what to do during stock market downturns. So I do hope you enjoyed this video. If you did, please hit like and also subscribe to the channel if you are new here. But that's it from me for this one, and I'll see you in the next video. Cheers.